Some of the investors have used home equity line of credit, also called HELOC, to expand their real estate portfolio. And some of the investors used HELOC when the real estate market was so high. So what happens to your HELOC if the property values goes down below your mortgage? For those who are confused, HELOC is a line of credit and it uses the equity of your home as a guarantee that you will repay any funds you have borrowed. So what happens to HELOC if the value of the underlying asset goes down? First, it's important to understand how HELOC works and what are the different types of HELOC. HELOC is a line of credit that is secured by the equity in your home. Generally, HELOC interest rates are higher than mortgage rates. So now you might be thinking how this is different from a mortgage. HELOC is flexible when it comes to repayment terms. With a traditional mortgage, you are required to make payments that include principal and interest. But with a HELOC, you can make interest-only payments. To get approved for a HELOC, you will need at least 20% equity on your home. HELOC allows you to borrow up to 65% of the property value. These are the two kinds of HELOCs: a HELOC combined with a mortgage and a HELOC of its own. A HELOC combined with a mortgage acts like a credit card. If you have maxed out your credit card and if you make a payment of $100, most credit card will add $100 right away to the spending limit. Now you will be able to spend $100 with that credit card. HELOC combined with a mortgage also acts the same way. When you pay down the mortgage portion, the credit spending limit on the HELOC increases right away. The second type is HELOC of its own. This HELOC is just the opposite of HELOC combined with a mortgage. When you pay down the mortgage, the credit limit of the HELOC stays the same. It acts like a loan. When you make a payment, the loan value goes down and you are not able to make withdrawals from that loan based on your repayment. You can even have this HELOC from a completely different lender since the mortgage and the HELOC are not directly correlated. Now let's see what's going to happen if your home value drops below the mortgage amount. Most lenders typically respond in these three ways. If the house value drops, meaning if the value of the collateral drops, then the lender could lower the borrowing limit on your HELOC. And if the new borrowing limit is below the current outstanding HELOC balance, then the lender could ask you to pay off the difference immediately. So that's how most lenders react. But in some cases, lender will ask borrower to pay back the whole outstanding loan. And this happens when something goes wrong with the borrower, especially when the borrower misses a payment or when the credit score of the borrower takes a dive. The third way a lender can react is by converting your HELOC into a mortgage. If the value of the collateral goes down, lenders will try to protect funds by converting HELOC into a mortgage, and you will be required to make mortgage payments that includes principal and interest, which can increase your monthly payment since you can no longer make just interest payments. Before I conclude, if you have a HELOC, try not to max out your limit and also make sure to make regular payments. Leaving some unused room in your HELOC can save you. So, if your lender decides to cut down your HELOC limit, it might not affect you and you don't have to worry about making a huge payment. If you found value in this content, consider leaving a like, and thanks for watching.